You check Bitcoin's price on your phone. It's down 8% since last night. No headline explains it. No hack, no crash, no tweet from anyone famous. Just a red number where a green one used to be. You refresh the app, thinking it's a glitch. It isn't. Something moved that price while you were asleep. And it wasn't the market you think you understand. Here's the reframe. You've been taught that Bitcoin's price comes from millions of individual buyers and sellers, all reacting to news, fear, and greed. That's true for a small slice of the market, but a growing share of Bitcoin's daily price action is now set by a handful of banks and trading firms running a trade you've never heard of, inside a legal gap regulators left wide open. It isn't hacking. It isn't insider trading. It's simpler than that, and far harder to see. Start with what actually happened the last time researchers proved manipulation in this market. In 2019, finance professors John Griffin of the University of Texas and Amin Shams of Ohio State published a study called "Is Bitcoin Really Untethered?" They pulled over 200 gigabytes of blockchain data and traced every movement of Tether, a cryptocurrency supposedly backed one-to-one by real dollars. What they found was specific. Just 95 hours of concentrated Tether purchases accounted for 59% of Bitcoin's price growth over an entire year, from March 2017 to March 2018. Tether was being issued and used to buy Bitcoin precisely when prices were falling, propping the floor back up. 2 years later, in October 2021, the Commodity Futures Trading Commission fined Tether's operators $41 million for lying about those dollar reserves. The mechanism researchers described on paper turned out to have regulatory teeth behind it. That case is old news now, but the pattern it revealed wasn't unique to one exchange. In March 2019, the asset management firm Bitwise Asset Management submitted a report to the Securities and Exchange Commission, analyzing 81 crypto exchanges. Its conclusion was blunt. An estimated 95% of reported Bitcoin trading volume on those exchanges was fake. Wash trading, where the same firm buys and sells from itself to inflate the appearance of demand. Only 10 exchanges, Bitwise found, showed real, organic volume. Regulators read that report. Exchanges tightened up. Watchdogs started tracking stablecoins and volume claims more closely. But the story didn't end. It moved somewhere new, somewhere far more boring on the surface and far bigger underneath. The banking system itself. Here's the part most people miss. Under Basel Committee capital rules adopted globally in 2022 and 2023, a bank that wants to hold actual Bitcoin on its balance sheet has to set aside capital equal to 1,250% of that position's value. For context, a mortgage loan might carry a risk weight of 50%. 1,250% effectively makes direct Bitcoin ownership impossible for a regulated bank. You'd need more than the entire value of the position sitting in reserve, doing nothing, earning nothing. So banks don't hold Bitcoin. They never plan to. Instead, they found the loophole sitting one step removed: derivatives. The Chicago Mercantile Exchange lets institutions trade Bitcoin futures, contracts that settle in cash based on Bitcoin's price, without anyone ever touching an actual coin. Futures don't carry the same brutal capital charge as spot Bitcoin. And once spot Bitcoin ETFs launched in the United States in January 2024, banks got the second half of the puzzle: a security that tracks Bitcoin's price and trades on a stock exchange, wrapped in the same regulatory language as any other fund share. Now watch how those two pieces fit together, because this is the trade. A bank buys shares of a spot Bitcoin ETF. At the same time it sells, shorts, an equivalent dollar amount of CME Bitcoin futures contracts. This is called a cash and carry trade, or basis trade. Bitcoin futures usually trade above the spot price, a condition called contango. Future buyers pay a premium for certainty. That premium is the bank's profit. Buy the ETF, short the future, collect the spread between them, and the position is close to market neutral. It barely matters whether Bitcoin goes up or down, because the ETF gain and the futures loss, or vice versa, cancel each other out. Trading firms like Jane Street have leaned into this exact structure at scale, according to reporting on CME open interest data through 2025. The trade doesn't require believing in Bitcoin at all. It requires believing in the spread. Let's make that concrete. Say Bitcoin trades at $60,000 in the spot market, and the CME futures contract, expiring in 3 months, trades at $62,000. That $2,000 gap is the basis. A bank buys $10 million of the spot ETF and simultaneously shorts $10 million of the futures contract. If Bitcoin rockets to $80,000, the ETF position gains roughly 33%, but the future short loses almost exactly the same percentage, because the contract was betting against that exact move. If Bitcoin crashes to 40,000, the same thing happens in reverse. Either way, the bank isn't betting on direction. It's locking in that original $2,000 gap, annualized into a yield, funded largely with borrowed money, at a scale retail traders can't touch. Multiply that $10 million example by the billions actually flowing through CME open interest, and you start to see how much of the market is really just this one structural trade, repeated over and over. So picture what that actually does to the price you watch every day. When a bank buys hundreds of millions of dollars in ETF shares, you'd expect that demand to ripple through and push Bitcoin's spot price higher, the way any large buy order would. But ETF shares are created and redeemed by authorized participants, a small set of firms that can generate new shares without necessarily buying Bitcoin on the open exchange in that exact moment. Demand gets absorbed inside the plumbing of the fund instead of hitting the spot market directly. Rallies that should happen on genuine buying pressure get muted. Then, every quarter, CME futures contracts expire. Banks holding the short side of the basis trade have to close out or roll their positions. That unwind is where the volatility shows up. Sharp, synchronized selling that has nothing to do with news, sentiment, or your local exchange's order book, and everything to do with the calendar date printed on a futures contract. This is the counterintuitive twist, and it inverts what most people assume. You'd think a manipulation loophole means someone is aggressively pushing Bitcoin's price up or down for profit. It's closer to the opposite. Banks running this trade largely don't care which direction Bitcoin moves. They've hedged that risk away. What they care about is the spread, the premium, the contango. That means their buying and selling isn't driven by conviction about Bitcoin's future at all. It's driven by an accounting identity between two markets that most retail investors never look at side by side. The Securities and Exchange Commission's own Hester Pierce flagged part of this asymmetry publicly in January 2023 in a dissenting statement titled, "Out, Damned Spot," criticizing the SEC for treating Bitcoin futures products as safe enough to approve years before spot products. Even though futures pricing depends entirely on the spot market, it was supposedly more dangerous then. The regulatory gap between the two product types is exactly the gap banks are now trading through. This isn't the first time a safe market-neutral basis trade has turned dangerous. In March 2020, hedge funds running an almost identical structure in the U.S. Treasury market, long Treasury bonds, short Treasury futures, collecting a tiny spread with heavy borrowed money, were forced to unwind all at once as volatility spiked. The selling was so violent, it froze parts of the world's safest bond market and pushed the Federal Reserve into emergency intervention. The mechanics weren't about bonds specifically. They were about leverage on a spread trade, everywhere it exists. The same shape of risk now sits inside Bitcoin's basis trade. Smaller in dollar terms today, but growing every quarter. That spot ETFs keep pulling in institutional money. Here's what this means for your money. Even if you've never touched a futures contract in your life, if you own Bitcoin or an ETF that tracks it, part of the price chart you're staring at isn't a referendum on adoption, inflation, or the next halving. It's the visible residue of institutions capturing a spread you can't access at their size or their borrowing cost. When Bitcoin sits unusually flat for weeks, then drops sharply with no headline attached, check the calendar before you check the news. Futures expiration dates on the CME happen like clockwork, and so does the selling that follows. You're not paranoid for noticing the pattern. You're just seeing a market structure that was never fully explained to you. None of this makes Bitcoin worthless, and none of it is illegal. Basel's capital rules are public. CME's contract specifications are public. Spot ETF creation and redemption mechanics are filed with the SEC for anyone to read. The loophole isn't hidden in the dark. It's hidden in plain, technical language that most people never have a reason to open. That's the real lesson underneath the price chart. Markets don't reward the people who react fastest to red numbers. They reward the people who understand why the number moved in the first place. So the next time you check Bitcoin's price, and it's down 8% overnight, with no hack, no crash, and no headline in sight, you won't refresh the app wondering if it's a glitch. You'll know exactly whose trade just closed, and why the market never needed you to notice.